How to make money in real estate. Lecture 3. How to estimate the cost of buying and managing rental property. Hello everybody. Welcome to the third lecture of the series How to Make Money in Real Estate, in which you will learn how to estimate the cost of buying and managing rental property. One of the biggest issues is to save enough money in order to be able to buy and manage a rental property. Saving money is the key to being able to make a lot of money with rental properties. When you try to buy your first rental property, you must have enough money for the down payment, repairs, closing costs and carrying costs. The first thing you must do before you decide to buy a rental property is to estimate the cost of buying and managing rental property in order to set your budget. When you became serious about investing in rental properties, it will take you up to 2 years or more to buy your first property. The time it takes based on the money you have, your goals, the market and much more. Take your time and do not stress yourself out about buying a property as quickly as you can. In this lecture I will develop the following topics: expenses to consider when financing a rental property, estimate initial cost to buy rental properties, acquire rental properties without putting all your money down, the cost of borrowing, property inspection, closing cost, costs required to own and manage rental properties. Expenses to consider when financing a rental property. Aside from initial costs, a rental property investment will encompass a range of expenses. It is essential as an investor to remain informed on all the possible expenses for your investment. In doing so, you can make accurate estimations when creating your budget. The most common expenses to consider when financing a rental property are: loan cost, appraisal fees, home inspection, insurance, closing costs, property taxes, maintenance, utilities, property management, property improvements, vacancy costs, which I am analyzing in detail below in the paragraphs that follow. Estimate initial cost to buy rental properties. You must work hard to find the best deal. Figure out the best place to invest. And make sure you have enough money to invest. You can invest in rentals immediately, or it can take even more time depending on your financial situation, education level and drive. Acquire rental properties without putting all your money down. To buy a property with little money down, you need a mortgage, or in other words a loan. Take in mind that no bank will lend you money with no money down. Rental property loan requires down payment, 20 to 25% or more, depending on the property and the borrower. So, you can try out the option of borrowing 75% to 80% of the total cost. Banks offer a reasonable loan repayment duration. This being the case, you can always organize yourself and get to grow your rental property portfolio using loans. To get the great returns on rental properties, you must use some of your own money. The less money you put down on a property, the more expensive the money you borrow will be and the smaller your returns will be. Of course, a cash buyer gets greater deals. One of the lectures that follows is explaining all the details you need to know about borrowing money and the best options of rental property loans. The cost of borrowing. It is always a good idea to do your homework before you make a major purchase. The more you understand about the cost of borrowing before you borrow, the better. The concept of a loan is straightforward. First you borrow money, and then you repay it. Depending on the type of loan you are applying for, you may be charged processing or application fee, property appraisal fees, interest rate, monthly service charges, prepayment penalties, exit fee. Depending on the type of loan you are applying for, you may be charged a processing or application fee. A loan processing or application fee is a fee borrower may be charged for obtaining a loan. The loan application fee is paid in advance and is usually non-refundable charge that borrowers are required to pay when they submit a loan application. Loan application fees will vary by lender, and many lenders will not charge a loan application fee at all. Therefore, borrowers should first do due diligence on their own credit score and the standard approval requirements for the type of loan they wish to obtain to ensure that the application fee will not be lost with a credit application rejection. Application fees vary significantly among different types of lenders, ranging on a mortgage loan anywhere from €0 to €500. You will also pay property appraisal fees. The lender needs to know what the property is worthing. The lender uses an appraisal fee to hire an independent licensed professional who will determine the property's overall value in question, and you will be required to pay for it. This rental property expense includes an inspection of the property compared to similar properties in the local area, recent sales that may have happened to these similar properties, and a final appraisal report using all the information gathered. The value of the property is used to determine the percentage of how much you are borrowing compared to the value of the property. This is called loan-to-value ratio. For example, if you are borrowing €75,000 and you are acquiring a property that worths €100,000, your loan-to-value ratio is 75%. The appraisal fee is on average about €300, €400 for a single-family home and €500, €700 for a multi-family property. Insurance. Typically, you may be required to have an insurance when you take out a loan. Property insurance refers to a series of policies that offer either property protection or liability coverage. Property insurance can include homeowners insurance, renters insurance, flood insurance, and earthquake insurance, among other policies. The three types of property insurance coverage include replacement cost, AC to all cash value, and extended replacement costs. For insurance, add an annual expense between €500 to €1,000. Once the initial application have been approved, your loan will have two main components: principal and interest. Principal is the amount you are borrowing, and interest is the percentage of that amount that you're charged for the privilege. You can get a variable or fixed rate. Interest rates are important because, other than the amount you are borrowing, nothing else will have as large an impact on your payments. What determines how much interest you will pay? Lenders use a lot of factors to determine interest rates, including inflation levels. Risk is a key factor that lenders will take into consideration. A risky investment will cost you more. A high credit rating can lower your interest rate. Interest rates can vary by more than a percentage point depending on your credit score and may also mean the difference between being approved or denied in the first place. A shorter loan term can lower your interest rate. The term, or how long the loan period is for, will also affect your interest rate. Statistically, longer-term loans have a greater chance of not being repaid, so they carry higher rates. The amount of your loan impacts your interest rate as well. The interest rate will also be determined by how much you borrow. Again, it all comes down to the lender's risk of being paid back. The more borrowed, the greater the chance of default. The average mortgage interest rate for borrowers with good credit scores on a 30-year fixed-rate loan is about 4%. For example, if you borrow a €10,000 loan with an interest rate of 4.00% for a period of 1 year, the interest you owe will be €400. This means you would repay a total of €10,400. Monthly service charges. Some loans will carry small fees each month to cover the cost of sending out monthly statements, collecting payments, keeping records, following up on any late payments, disbursing funds to the proper place, prepayment penalties. Some lenders do include a penalty fee in the terms of the loan in order to ensuring they make what they planned when they offered it to you. You might see something called an exit fee, which is similar to a prepayment penalty but due any time a loan is paid off, even at its full maturity. When it comes to applying for loans, the amount you are borrowing and the interest you are charged to borrow will be the two largest chunks of the payments you'll make, but not the only ones. As with all major purchases, do your homework and be informed to make the best decision. Property inspection. It is essential to hire a professional inspector to conduct a home inspection before investing in a rental property. Damage such as mechanical failures, damage within hard-to-find areas, mould, or roof damage. This expense will save you money in the long run as a rental property investor. If these problems are not addressed ahead of time, you will need to make these repairs at a later date, subtracting from your profits. A home inspection costs between €200 and €500 depending on the property's location and size. Closing cost. You will also have closing costs when purchasing an investment property. Closing costs are fees associated with property purchase that are paid when the title of the property is transferred from the seller to the buyer. Closing costs are paid by either the buyer or seller. Repairs. If you are purchasing a distressed property, improving it to the point that it attracts tenants will cost you less amount rather than purchasing a modern property. Repairs add a large amount to how much money is required to buy a rental property, but you have to wait for the repairs to be completed before it can be rented. While you are waiting for repairs to be completed, you are paying carrying costs on that property, which also increases the money needed. You will have to pay interest, utilities, taxes, and insurance until the home is rented. It will take a month or two to have a contractor complete most repairs, but it sometimes takes longer. Repairs usually cost more than first estimate. On a house that needs minimal repairs, assume that you will need at least €5,000 in work done before it can be rented. On a house that requires more repairs and updates, you may spend €20,000 or more. It is always the little things that take time and add up to big repair costs. As a general rule, always add €5,000 for unknown costs on any rental that you buy. Make sure you get bids if you are not an expert at estimating repairs. There are always unexpected costs and delays associated with repairs. Make sure you have enough money for the worst-case scenario. I suggest at least 6 months of mortgage payments, taxes, and insurance as reserves for each property you own. This would be money on top of the initial investment used for repairs and carrying costs. Cost required to own and manage rental properties. The required cost depends on the type of rental property. The most common expenses are property taxes, maintenance cost, utilities, property management, vacancy cost, variable expenses. Property taxes. Property tax is an expense, which is based on the current fair market value of the property. If you are looking to estimate expenses in regards to property tax, you should contact your county assessor to get the exact amount for the current property taxes. The taxes you will have to settle when you have an investment property are: income tax, It is the tax on income that you receive from renting out your property. Income tax can be offset by interest repayments on your loan as well as other deductions. Property tax, in some countries, is known as council rates. This is a tax that goes straight to local council, which funds community services and maintenance of public facilities. The amount depends on the land value of your property or the category of the property. Land tax. Some governments impose this tax, which is payable based on the combined unimproved value of the land you own. Land tax is typically calculated on what your land would be worth. Maintenance. Maintenance for a rental property is one expense that investors should never underestimate. They are tricky expenses, because you never know how much you would spend. Some months you could spend €100 on repairs, and other months you could spend €500 or nothing. Although maintenance costs will differ from every kind of property, investors maintain adequate funds for monthly costs related to the rental property. This includes maintenance to the outside, as well as interior areas of the property. In addition, these costs can relate to occasional repairs such as the building's heating system, roofing, or plumbing. Real estate investors need to anticipate the expenses of ownership, including actively planning and saving to meet these costs. Most experts recommend a maintenance budget between 10 to 15% of the annual property rent. Tenants' security deposits cover some of these costs. Utilities. In most cases, the tenant will pay the majority of utilities, but services like sewer and water are sometimes covered by the owner. Utility expenses may include electricity. Although usually paid by the tenant, many property owners still pay electricity for the property or part of the property, such as parking lot lights or storage areas. Gas and heating oil. This expense is also often paid by the tenant. Water and sewer. This is the charge for the use of city water and sewer. On homes, this is often paid by the tenant rather than the landlord, but this is not true in all cases. Trash and recycling. Garbage can also be paid by either the tenant or the landlord, depending on the arrangement. Investors are able to deduct the cost of utilities from their taxes. Property management. Property management is when you hire someone else to manage your property for you. However, if you decide to manage yourself, there are still associated costs, like paper, gas, advertising, wages for any employees you hire, and your time. Calculate property management expenses whether or not you plan to hire someone else, because it's still an expense. Besides, someday you will be successful and have numerous properties and will be unable to manage them all yourself. Investors should consider integrating a property management company which can add significant value to the investment. The duties and responsibilities of a property management company include setting rental rates, collecting rent, assigning maintenance, advertising, managing relationships, and finding new tenants. The benefits of a property manager consist of higher quality tenants, shorter vacancy cycles, better processes, fewer responsibilities, and fewer legal problems. The cost of property management will range from 8 to 10% of the monthly rent or a flat annual fee. Vacancy costs. Your property is not going to be occupied 100% of the time. Due to tenant turnover, vacancy costs are a rental property expense that may be impossible to avoid. The vacancy rate is given as a percentage based on the income that comes in. Therefore, a property that is empty 1 month every year would be vacant 8.3% of the time. A typical about vacancy rate is 5%. Variable expenses. Variable expenses are a rental property expense that should not be overlooked when setting your budget. Besides the fixed expenses listed above, there may be other expenses that are unique to your area. These expenses are calculated by using a percentage of the rent that comes in and may range from 2% to 5%. Add all together. Finally, it's time to add all your numbers and see what you get. At this point, it's as easy as adding, subtracting, and a little multiplication, using a calculator. Understanding how to calculate expenses is a must. There is no perfect way to predict the future of your investment property, but taking a simple, mathematical approach to expenses will be very helpful. These numbers are averages, but should give a fairly close guess at what your financial future will be. Many landlords fail simply because they do not do the calculations. They buy properties based on emotion, gut feelings, or bad calculations and then wonder why they lose money. The 50% option. If you just want a rough estimate, enter the 50% of the annual rent. It is a simple calculation that helps estimate expenses quickly. The 50% rule states that half of what you make in rental income will leave in expenses, not counting the mortgage payment. Sometimes expenses fall in the 40% range or up the 60% range. However, you can assume that your annual expenses are about 50% of the annual rent. Thank you for watching the video. If you watch all my lectures, which are free, you may be able to start investing in rental properties a little quicker. Please subscribe to my channel and press the bell to get alerts when a new video is posted. Please write your comments, questions, or concerns you would like to share.